In Chapter 8, we look at the consolidation process and the preparation of consolidated financial statements when the equity of the subsidiary includes preference share capital. In all the previous chapters, the equity of the subsidiary only includes ordinary share capital. But before we can look at the effect of the preference shares of the subsidiary on the consolidation process, we need to understand preference shares. So talking about the nature of preference shares. In their name, preference shares, it indicates that these shares have preference above other shares. The preference shares can therefore exist only if another class of share that is subordinate to the preference share also exists. The preference shares are only entitled to dividends once it is declared, but they have a first right to these dividends. So although the preference shareholders will be entitled to dividends only once dividends have been declared, the entity would first have to declare preference dividend before they declare an ordinary dividend. And if there are then distributable reserves left after the preference dividend was declared, then only can dividends be declared to the ordinary shareholders. So we can now say that the preference shares enjoy a preferential right in respect of dividends declared by entity. They need to get it first before the ordinary shareholders. But they also enjoy a preferential right in respect of the repayment of their capital during liquidation. But it's important to understand that they only have a preferential right to the repayment of their capital on liquidation of the company, because the preference shareholders are not entitled to a pro rata share of the net assets at liquidation of the company as the ordinary shareholders do. Now, in terms of dividends, your preference shareholders are usually entitled to a fixed annual dividend that is calculated as the number of shares held multiplied by a fixed dividend per share. This is different from the ordinary share dividend. The ordinary share dividend can be any amount proposed by the company and approved by the shareholders on the shareholders meeting. It is not linked to a fixed dividend per share amount, as is the case with the preference shares. Important to understand, and it will come through later on when we talk about control, your preference shareholders usually do not have any voting rights. Under certain circumstances, preference shares may obtain voting rights. It depends on the stipulations of the memorandum of incorporation of the company, but that falls outside the scope of Chapter 8. We assume that the preference shareholders do not have any voting rights. So my preference shareholders have a preferential right in respect of dividends above the ordinary shares. But I also have different classes of preference shares. And the first class I want to look at is the cumulative preference shares. In the previous slide, we said that the preference shareholders are only entitled to a dividend once the dividend has been declared. But for cumulative preference shareholders, if no dividend is declared in a specific year, it is regarded as being in arrears. It means that that dividend accumulates annually to the cumulative preference shareholders. So even though the dividend is not declared in a specific year, the preference shareholder, being a cumulative preference shareholder, will be entitled to that annual dividend. That means that at the next dividend declaration, the first time the company declares a dividend again, they will have to declare all accumulated preference dividends that are in arrears first. Then they can declare the current year preference dividend and then only declare the ordinary dividend. The company declaring the dividend will not have a current liability in its SFP for any dividends in arrears until the date when the dividends are declared. Remember, you only have a current obligation to pay the dividend once it is declared. But the cumulative preference shareholder is entitled to that annual preference dividend. And the effect of that is extremely important when we come to the consolidation process. In questions and examples and tests, please assume that your preference shareholder is cumulative unless specifically stated otherwise. I quickly want to do an example to illustrate the effect of this cumulative preference dividends in arrears. So let's assume I'm working with a timeline and I have 1, 2, 3, and 4 reporting periods. So in year 1, year 2, year 3, and year 4, assume that there was no preference dividend declared in year 1, no preference dividend declared in year 2, also not in year 3, but then in year 4, the company is able to declare a dividend. If it is cumulative preference shares, in year 4, the company will first have to declare the dividends for year 1 and year 2 and year 3, then for year 4's preference dividend, and only if there's still distributable reserves left will the company be able to declare an ordinary dividend as well. This is the case when it is a cumulative preference share. And starting to talk about concepts of consolidated financial statements, the cumulative preference shareholder is entitled to a dividend in year 1 and year 2 and year 3 and year 4. Also remember that both entities, the shareholder and the company declaring the dividend, will only be recognizing the economic event, the transactions, in their financial statements in year 4 when the dividend was actually declared. Only then will the shareholder recognize dividend income, and only in year 4 will the company declaring the dividend recognize dividend declared and shareholders for dividend. As we get cumulative preference shareholders, we also get non-cumulative preference shareholders. And the effect of a non-cumulative preference shareholder is that if no dividend is declared in a specific year, that dividend is lost. The non-cumulative preference shareholder is only entitled to a dividend in the year in which the dividend was also declared by the company. Let's also illustrate that with an example. Again, looking at a timeline representing my reporting periods, and I have 1, 2, 3, 4 reporting periods, year 1, 2, 3, and 4, and we assume that the preference dividend was not declared in years 1, 2, or 3, but that the company decides to declare a dividend in year 4. When it is non-cumulative preference shares, the dividend declared in year 4 will only be that of year 4, only that preference dividend. The 3 previous years is not regarded as being in arrears, those preference dividends, so you'll only declare the preference dividend for year 4. And then the ordinary dividend will be declared after this if there's still distributable reserves left. Again, talking to some group statements principles, if you have a non-cumulative preference shareholder, the non-cumulative preference shareholder is only entitled to a dividend in the year in which the dividend was also declared. For purposes of preparing consolidated financial statements, it is very important to distinguish between cumulative and non-cumulative preference shares, as it has a direct implication in the preparation of your consolidation journal entries and ultimately the consolidated financial statements. You will see the effect of that in the examples in Chapter 8. Just refer back to this concept when we do those examples, and it will all focus on what is the preference shareholder entitled to. And your cumulative preference shareholder is entitled to a dividend regardless of whether the dividend was declared or not. And your non-cumulative preference shareholder is only entitled to a dividend in the year in which the dividend was actually declared.